starting with this first on the quote, you can see FS Bull 20. So you click on it as I showed us yesterday. When you click on it, then you click charts, right? And then I showed us how to change the colors, and you can do that on your own. And then I showed us this line that goes up from up to bottom is what separates the day, the daily time frames. So I would like to make it 1 hour. The 1 hour actually, I later found out that the 1 hour actually gives you 24 candles. So let me pick up my tools that I use. I remember yesterday I showed you that I always use this tool. Then I showed us how you can actually customize this tool. So I'll make it a bit bold for illustration. So it's like what I use my stick for the purpose of illustration to actually make sure you understand what I'm talking about. So you remember in the video, I spoke about each of these candlesticks, the interpretation of this candlestick. And somebody asked me a very interesting question yesterday, the importance of this week. This week, I told us that this line you are seeing is a week. And then I told us that this gray color you are seeing here is when the candle is coming down, when the market is coming down. And then when the synthetic is losing value or coming down, it's called bearish. This range of candles, 1, 2, 3, tells you a bearish movement from this top to this level. Then while this lemon color is telling you a bullish move from this candle up to this candle. And I told us that the body, the shape of this candle tells us a lot about the candle. So when I talk about this candle, this one I'm pointing at tells you that it's a bearish candle. The market, I told us that where the body starts is where the market opens and it comes down. And because it did not close down, it went up. That means that everything that happens here is history. And the market will always tell you, leave prints in the market or whatever happens. The market is so clear and transparent. There is no room for ambiguity. I'll be telling us what is price void, volume void, fair value. All these things we'll be talking in subsequent class. Today, I just want to talk us elementary by class, little by little. Just as I said, I will not compress 15 years experience into a day or two. I will be doing well. It's just like giving a baby pounded yam instead of milk. So some of us here are advanced and intermediate. Probably just follow me. You will have a lot to learn. So this candle here, just as I was speaking earlier, sorry, my tool is it's not easy doing these tutorials on phone, but it's like majority of us use phone, and so that's why I'm using phone. So this line here is called the week of this candle. Sorry, my tool is just acting for me. This week tells us that where the week ends here is the low, where the body starts is the open, where the body close ends is called the close, and then where the body goes up is the high. Now, because this is a bearish candle, that means that the price was coming down. What it means is that the price opened from the top and closed bottom. While for bullish candle, the price opens from bottom and closes up. Please understand the difference. For bearish candle, it opens from the top and closes bottom, and close below, while bullish candle open below and close at the top. That's the difference between bearish candle and bullish candle. And each of them, whether bullish or bearish candle, they all have one thing in common, which is wick. Not all candles have wick, but most candles always leave wick. They both have wick. Now, for this bearish candle, it has this up here is the high, and this end of this week is the low. The open price is at the top, the close price is below. While the next candle that follows it, you can see it doesn't have a wick. That means that both the open and the low is the same price, right? So when you check this, you find out that the price started from this candle without wick, went up and closed where this particular candle body ends, but that is not where the market stopped. The market actually went all the way to this point and came back, because the market has to tell you there's nothing hidden here. The real price is shown on the chart. So you see that the market actually went all the way to this point and came back. Then the next candle that followed it was the bearish candle, because I said earlier that the bullish candle starts from bottom and close up, while the bearish candle always starts from top and close below. So because this bearish candle closed there, the next candle that will follow will definitely open where the previous candle closed. So this candle opened from where this candle closed and then went up. And since this candle closed here, the next candle that will follow it will be the open candle. It could open from here. If it goes up, fine, that's a bullish candle. But because the market, this candle opened here, instead of going up, it went up a little and left a little weak, then came back down to this point and went back upward. So it's a bearish candle. The next candle that followed it. So that's how everything happened. So when I try to, let me try to reduce this so that now I told us how to do this to give me enough room to see historical data. Historical data is the range of candles that happened within the day. This is today. Sunday begins from where this white line, you see, from top to bottom. The next candle, this is a 1 hour time frame. You can see 1 hour is highlighted here. You can see 1 hour is highlighted here. In case you don't, another place again to actually know what time frame I'm using. It's at the top here. You can see 1 hour here, showing 1 hour here, right? You can see 1 hour here. So that tells you the time frame I'm using. And then the range of candle begins from this point to this point downward. So the range of candle have been flowing downward. That means the market has been bearish for today, for this FS volume 20. Why? How do we know that it is bearish? Because you find that the market, the range of candles have been coming down, right? You find out that I show us how to pick this tool to show our support and resistance. I pick this candle, which is a horizontal line. I find the highest in this range of candle, and the highest happens to be here. Then I show us how to duplicate this line, and then I duplicate it by clicking this icon, and I bring it bottom. And I see, just to show the difference between support and resistance, we change the color. So I would prefer to change this color to show that this is support. I will change this color to, you can give it any color. I told us you can choose any color. Then you must not use the colors I'm using. And so I have chosen the low. Now I will show us another way to do this, right? Now this is for today. What about what happened yesterday? Now we'll use what happened yesterday to predict what will happen today. Now how do we do that? Let me show us. What you should do is to go to daily time frame. You click on this day time frame. You can see now. You see what do you notice what happened? You remember on the 1 hour time frame, I picked the highest candle within this range, the topmost candle, right, within the range of candles that flow from this point. My tool has disappeared. I don't know where it has gone to. Sorry, I have to pick this tool. I have to pick this tool. I don't know, pick my tool again. Because with this tool, it helps me it will help you to understand what I'm talking about. So I pick the topmost in this range, which is this candle, these two candles, and this candle, this bullish candle happens to be the highest, and then the lowest happens to be this bearish candle, right? The low of this bearish candle. You can see this bearish candle came down, opened from here, where this previous candle ended, and then came down, went up. So this is a bearish candle, and the next candle that followed is a bullish candle. And then it happens that they formed a support. And so another way of doing this, if you don't want to do 1 hour, you find that you just click on this icon and then click here. Now, if you check, okay, my tool is actually here. I just need one of them. So let me just pick this two. All right. So let me try to enlarge it. You can see the selection I did on 1 hour aligns with the daily time frame. And I told us last time that on a daily time frame, each of this candle you are seeing here each of these candles here took a day to form. This was the previous candle. Today is Saturday. This candle that followed it is what? Friday, Thursday, Wednesday, Tuesday, and Monday, right? So this was the candle that formed Monday. Then you keep on like that, continue like that. So for now, we try to say, okay, this is for today, the support for today and the resistance for today. But let me show us the strategy we'll be adopting. Apart from showing what happens today, the low of today and the high of today, we will choose the high of yesterday, which happened to be the previous candle, and the high and the low of yesterday. That is the easiest way. Because if you want to do it on 1 hour, you have to compress this chart, and it won't be looking too good. So you can still do it this way. If that one is, you can choose to say, okay, what happened yesterday? I can choose to say 1 hour, then use this top to bottom white line. My tool has disappeared because of this chart. Let me pick my tool, please. So I was trying to adjust my tool. So I hope you are following, please. You are seeing my screen and you are following, right?
Yes, sir.
Yes, sir.
So those that are just coming in now, please, sorry for coming in a bit. We have not really gone far. I'm just showing the audience how to set support and resistance using the tools. So I just try to compress the chart to daily time frame. Yesterday, I showed us how to just select the daily time frame here, and then select previous day high and previous day low. And so using the 1 hour makes the screen a bit too compressed, too compressed. It doesn't look neat, right? And then, but some people could prefer to go this way. And then I showed us how to pick up tools. This line, horizontal line from top to bottom, separates the day. Today is Saturday, so it's turning out from this horizontal line, top to bottom, this horizontal line to this horizontal line, vertical line, vertical line. I mean this top to bottom vertical line, the white dotted line, vertical line, this one to this one is Saturday. Then this one, the previous one to this one is, sorry, my tool is just, it's not easy working on the phone with this. Then from this point to this point is Friday. So that's what it means. So instead of compressing your chart and make it a bit difficult for yourself, because when I do this, I just want to get yesterday's low this way and yesterday's high this way, right? When I do this, so make sure always click and make sure that the horizontal line, this is my support, this is my resistance, and make sure that the horizontal line is not highlighted, because if you click, if you are trying to do something, to be moving, so you need to lock it by clicking, by pressing and hold, press and hold, and if you press and hold, it highlights. You press and hold again, you have locked it, so that way it won't move in case you are trying to move your chart. And so what we just did now was to pick on 1 hour time frame, was to pick yesterday's low and yesterday's high. Another way to do it is to just click on your screen and select day time frame, enlarge the screen. I showed us how to enlarge the screen. Just put the two of your fingers and drag it up, or compress your hand, bring your fingers together this way, up, down. Once you go up, one down. So that way you expand, contract the chart, and then this way you can increase the length of your chart. You can choose whichever way. You can zoom in and zoom out. I showed us how to do that yesterday. And so another way of getting previous day high and low, I told you on the daily time frame, each of these candle takes a day. So it shows that the data of today has been compressed into one candle. which is this candle. The data of yesterday has been compressed into this candle, which is this previous candle. The same way all these candles you are seeing, it's every candle that happens that day has been compressed into a single day candle. That way we can analyze over a long period of time, maybe weekly, monthly data. We can just compress everything and see what happened over a period of time. Now, if I pick yesterday's high and low, right, which is this candle, what am I trying to do? All I need to do is come back to daily time frame, contract again, and this way you can see when you come to daily, it's showing you that the support was breached. Sorry, I have to contract this way. The support was breached. I have to pick my tool. The tool is somewhere. So on a daily time frame, it's easily accessible. When I reduce the time frame, it's somewhere behind in the historical data. So if you notice something, you notice that the support was breached today. This support you are seeing was yesterday's low, while this top you are seeing was yesterday's high. And today, data market started from this vertical white dotted line that started from top to bottom, this line here. Now, what has been happening to this market? You find that the market was actually coming. Sorry, see, I didn't lock this support, this yesterday's support. So you see, I didn't lock it. Moving this chart. Sorry, I need to delete some of these tools. I didn't lock that horizontal line, so I need to lock it. So coming back to 1 hour, what is this tool now? I have to just see when I come back to see this thing is always unlocking. Just be patient with me, please. Because you need to be very precise in getting these horizontal lines. You don't guess it. You just have to be precise. You just have to be accurate. So I'll just have to pick another tool. Because this tool is helping me to illustrate and show you what I'm doing. So you notice something, that this support, yesterday's support low was breached, and then where do you think this price is going? Meanwhile, remember we have moving averages. These moving averages, I showed us how to add it yesterday. We have these moving averages. You click on this on the screen. You click on this icon. These are the moving averages. The first one here is 9, which is red. The second one here is what? 13, which is gold. And the exponential close. And then the next one here, which is 50. You can also add 200, but I decided to just leave it here. And then we also have RSI, which is relative strength index. What do we analyze this market? Now, check what happened. The RSI, my tool cannot show you the RSI. It doesn't go beyond the chart window. You check at the RSI. I adjusted the RSI, which I said I was going to show us today. By default, the RSI has 2 points, which is 70 and 30. But I adjusted, you can always tweak it to what you think is best for your analysis. Now, what did I do? Click here, come to this icon, come to relative strength index. Now, I use the period 3, then I applied it to close, then the level, which is this point, I actually, where there's the description, when you remove this in its description, when you check, you see that there's description. And I told us that this point is called oversold. And then I decided to use 10. 10 is oversold. Why did I choose 10? Why? Because I adjusted the period from 14, which is default, to 3. I have reduced it. That means that it will show me the volatility and it will be very fast. Because it's a very volatile market. It's not a slow motion market. So I need a period that is very fast with the market. And then I need a level that shows me the extreme low that the market can go and the extreme high the market can go, and gives me the midpoint between the high and the low. Now, the midpoint between, the difference between 90 and 50 is 40. And then the difference between 50 and 10 is 40. Do you understand what I'm saying? The midpoint will be 50. Between 90 and 10, the difference between them is 50. If you take 50 out of 90, you have 40. If you take 10 out of 50, you will still have 40. So that means that 50 is the right midpoint. And so that is how I got it. And then when you check the chart, you see the chart clearly will show you oversold and overbought with the midpoint. Now, how do we use this to trade? When I pick yesterday's low, which is this support, and then my RSI has touched 10, which is oversold, I should be looking for opportunities to buy. But I will not buy. Do you know why? I will wait for the market after breaking the support to return back and close above this support. That is a more safe entry. If the market just get down here, and because the RSI is at 10, you don't know how far this market will go. This RSI, the fact that it is showing 10 does not mean that you should just enter buy. This buy can, this candle, this range of candle that began from this point down here can keep on going down, while this RSI can still go below 10. And because this market can be very volatile, your small entry can just keep on going down. You could just be seeing a drawdown. It will go up, but the problem is that you entered too early. Now, if an aggressive trader can just enter too early. Now, there's no problem entering too early. Probably when the market touches the support, you just enter. Unknown to you that it will still go down. How do you know that it will still go down? This candle, you are just seeing one candle, two candles. When you reduce the time frame to 5 minutes, you'll be shocked that it really went down. You see how many candles? Many candles that broke this support level and came down. When you take it to 1 minute, it's completely another thing. You have to scroll down, you see that it went down. You see it went down, went up, went down. So most times, you don't just, because the market has touched the support, you just jump into the market. No, you wait. How do you wait? We still go back on the 1 hour and wait for it to return. This, let me just mention this. Trading requires a lot of patience. A lot of patience. At times, the market could just come here, touch here, and bounce. The fact that it bounced and left a wick below the supports, this support you are seeing is called liquidity zone. What the market makers are doing are trying to hunt for stop loss. Now, the asset I'm talking about here is not the spiking asset. It's just like the normal forex trading asset. So it does not spike. So you are safe. But if I go to the spiking market, let's take an example of a spiking market. Let me take PIN X800. Any of the PIN or gain, they are spiking market. Now, this is an example. You can see that I set a support and a resistance here. Let's do what I did in the other one. Let's pick yesterday's high and yesterday's low. This is a daily time frame. I expand it. Let me zoom out and then take yesterday's high, which is this bullish candle. Let me carry my tool so I understand what I'm saying, because in this tutorial, we are not assuming that there are people that are novice. They don't, what we're doing here, it looks like magic to them. So I have to do the tutorial as if we are teaching primary one, because there is a purpose for all these tutorials, is to build a community of people that are empowered. So we don't want to take anything for granted. So yesterday's low is here. And I told us that you can always choose the color. And so that when you go on lower time frame, you always know you're at support or at resistance. Sorry, let me adjust it and then lock it. And then lock it. So you see, yesterday's candle was a bit bullish. It came down to this point and broke the previous day, which is this bearish candle. It broke the low of it. This is the low of this candle, and then went back. And then there's a bullish candle, and then the candle that was forming today, instead of it to continue bullish, it started coming down. Now, why? Because today's candle went to yesterday's resistance. Yesterday's high became the resistance for today. And then yesterday's low is a support for today. How do we know? Now we'll go back on 1 hour. And I told us this vertical dotted line that cuts across the screen from top to bottom shows us our day, the candle, the range for today. And so the range for today, you can see that started from here and then down to this point. Now, today's candle started from where this vertical dotted line started. You can see the candle went all the way and almost touched it, right? Close to yesterday's high. So this becomes today's resistance. Yesterday's high is today's resistance, and yesterday's low is today's support, which is this blue line we are seeing here. It is this blue line we are seeing here, right? Now, what we are doing, since the market has touched yesterday's resistance, our expectation now is that the market is heading down to today's what? To today's support. This is a spiking market. Now, since it is pain will spike downward. The candles are counted upward. You can see each of these candles you are seeing here is a spike. On 1 minute, I went to 1 minute to see the spike. It's on 1 minute that you will see the spike. You won't see this spike, sorry. You won't see the spike on a higher time frame. You see the spike very well on a lower time frame. You see this spike, that means that the market will be spiking downward. So if you don't want spike, that means that in this market you should be thinking of taking the spike, picking the spike, hunting for spike. You should not be buying candles. If you're buying candles, if you're picking candles, all these lime candles, all these lime colors, we call them candles. We count them. You can say 1, 2, 3, 4. After 5, you jump out, or after 6, you jump out. And then if you don't jump out in time, all the profit you made from this point to this point, this spike will take it out. And then it will start counting again, counting. It will even get to the point you make profit, it spikes down again. And that's when it begins to cause high blood pressure. People begin to lose money because you are trading against, you see another spike. You see a spike just happened. You are trading against the trend. So if you are buying candle on a day like this, you are actually trading against the trend. What you should be doing, you should be looking for opportunity to sell, meaning you are hunting the spike and you make better money. Why do we say so? Why? Because we notice that there is a support and this market wants to go to the support. Please, any question before I go forward? Because I am getting to somewhere that some people, it may look complex, but those that are experienced, I believe is something they have learned and probably they don't know before. And it's like the puzzles are getting being solved. So where is this candle? We're hoping that this candle will get to this point. So I can as well assure us how to enter the market. I can as well, now this is a spiking market. I can just click sell. Now you can say I place the sell on 1 hour. Why? Because I have understood from my analysis that the market will come down to this point. What am I doing? I am trading with the trend. How do I know the trend? On the 1 hour, the market has been coming down. This is the range of candles from the resistance to the support. You can see from this point to this point, market is coming. So I showed us how to set take profits, stop loss, and all that. Now, let me explain something. On this spiking market, you can choose your stop loss, and your stop loss will be respected. Now, since I have done my analysis on 1 hour, starting from daily and then down to 1 hour, and I've entered a style, what I am doing now, I cannot choose to set my stop loss. How do I set my stop loss? I can go on 1 minute and say, I expect that I want to reach $1, $2, or $2.7, or I want to reach. You have to give allowances, because this stop loss you set, definitely the market will come down. But if you set the stop loss too close, it will take you out and then spike downward. You are out of the market, and you'll be angry that you missed this opportunity. Why? Because you put the stop loss too close. So in a market that we already know the trend that the market is going to go down, give good allowance, put a very good stop loss. Make sure that stop loss is above the moving average. Let it not be below the moving average like this, because this candle could come to this particular moving average and spike down. Some that have good amount of money, they will put it above the 50. This white, sorry, because I've not, this white line is the 50 moving average. This other one that looks like gold is 13. And then this one below red is the 9 moving average. So this gold and red are the fast moving average, while the white one is the slow moving average. The white one tells us when the trend is changing. It's confirming that the trend is downward. The white moving average, this is 50, always confirms the direction of the trend. If you go on 1 hour, you'll find out that every of this candle is below the 50 moving average, telling you that the market is down. When this candle is above the 50 moving average, is telling you that the trend is upward. That's the reason for this 50 moving average. It actually confirms the trend for us. I can as well trade without this moving average, right? I can as well trade without this moving average. And then the best place we should have entered, we're entering late. I'm just doing this for tutorial purposes. The best place we would have entered was when the market closed, this bearish candle closed below the 50 moving average, and then our RSI is above the midpoint. So above the midpoint is an opportunity for you to sell, and coupled with the fact that we understand the directional bias of the market, that since the market has touched this resistance, we are expecting it to come down to the support. It's not always like that. That are exceptional to this rule. But for the purpose of this, we're trying to take it simple, step by step. We have a lot to learn when they are exceptional. You could have resistance like this, and instead of the market touching the resistance and begin to come up, it will break it and go up. As long as the body of the candle did not close above this resistance and it closed below, my brother, we are down. We are more important. The week, somebody asked a question yesterday, the importance of that week. The importance of the week is very powerful. If the week is above this resistance and the body is below it and formed below it, you can enter fast trade. That means that since we are on pain, just know that it's going to be a spike downward market. Anything like counting candle, you'll be risking a lot of money. If you are counting candle, count and jump out fast. Like this bullish is counting candle, this bullish, if you go on 1 minute, this bullish is counting. You can see that they don't last, they are very short. And then this bearish candle, you find out that they are more bigger. You see, they are more bigger comparatively to the bullish candle, which are smaller. You find out the bearish candle are bigger. Look at this one that is forming down here. It's very large. So even though there is this counting that went all the way from, but these are very rich trade. Taking from here to here is for real advanced traders that know that this will happen from here to here. So I'm not showing us that one for now. When we reach intermediate level, we'll be showing that for now, this is beginners class. So this is beginners class for us to start using what I am showing you. You can use it to start making money. All you need to do is go back, watch the recording over and over, and practice on your demo account, right? So now I don't care. You can say that it's showing me minus whatever. I don't care because I know the market is going to spike. I have not lost. I only lose when I close this position. But as long as I've not closed this position, I'm still in the market. So, and that was why when we started that first day, there was a recommendation of how much you should start with. How much you start with gives you the capacity, the momentum to enter such kind of trade. Because when the trend of the day is a spiking trend downward, you make better, fast money. You don't need to wait from morning, from the beginning of this trade, from morning till evening. No, all you need is just one of these bearish candle, just this one of this 1 hour. And mind you, each of these candles you are seeing takes an hour to form. So if you can just spend 1 hour and enjoy this in this one within 30 minutes, and you use a good loss size of 0.1, you could just make $20 or $50, or even $10 or $5. You're done. You're making 3 or 5% of your capital. If you have $20, you make $2. That's 1%. If you make $6, that means you have made 3% of your capital, which is okay. So if you are making 3% in 10 days, 10 times 3, you have made 30%. So, which is good. Which bank will give you 30% in 10 days? And then in 30 days, if you are making 3 or 2%, in 30 days, you have made 60%. So imagine you put your money in your bank, will you make 60%? Now, why did I say 60% in a month? It's synthetic. That's what some people make in an hour or in a day. Some people make 100%, but we don't encourage such kind of trading. That's high risk trading. That is poor risk management. You can make 100% with the very good if you can spend the whole day picking each of these bearish candle, picking each of these bearish candle, picking of these bearish candle. Just concentrate on the spike and then take it. Now, the trade is going, it looks like it's going against me, but watch. If you are using demo account, I can tell you go to Pen X800 and just enter sell, right? With $200 demo account, just enter sell, put your take profit. Now, what I was wanted to show us earlier is how to put the take profit. I put my take profit at this support level, right? At this support level, I'm expecting to make $4.52, right? Then sorry, take profit at this. I can choose to make $6 because I am sure it's going to break the support. But if you want to be conservative, just put it above, right? $3.776. And then I put my stop loss above. Now I can choose, let me put my stop loss $10. I know it will not get to $10. It won't get to that point. But let me reach $10, right? But you don't reach $10 just to make $3.7. No. You should be risking half of what you are targeting. So if I'm targeting 3 points, you can just say, okay, I'm risking equivalent of what I'm targeting. It's called 1-to-1 risk ratio. That means 1-to-1. If I want to get $5, I risk $5. I want to get $10, I risk $10. Now, because we're entering late, that's why I'm doing this. But if you had entered from, let's say, somewhere here, right? Somewhere, sorry, let me take this tool. Let me show pending order. Let's say you have entered somewhere here, right? I would have put my stop, sorry. I would have put my stop loss somewhere here, where I'll be reaching $6.62. Then my take profit I'll be making like $18 to $15.7. You see, the risk to reward is a good one. Then I just place it. Now this is a pending order of what I should have done earlier, right? Let's assume that, okay, I don't even want to enter instantly. I'm waiting that probably the market will go up before coming to hit the support. This is what I should have done. My sell limit, I'm risking $6, right? To make $15.71. That means I'm making over twice the amount. This is 1.2, that's 1 to 2 risk ratio. What it means is that I am targeting to make twice of what I am trying to achieve. So you see, if I've entered earlier at this point, I enter from this point. If I enter from this point, you see, my stop loss is protected from where I entered. Let me pick my two. My sorry. You will notice that my stop loss would have been protected if I enter from here. Even though the market might have we came down and then went up, well, and then this one went up with this week, touching where I entered. I'm not afraid because I already know that the directional bias is down. I am below 50 moving average. I'm coming from this point down to this point. So I'll be targeting this point. And one thing you need to know, if I enter from here, I don't have to wait until it hits my take profit. The market is not 100%. You can be wrong. But see, what you should target is that if what I have gained from this point to this point is okay for maybe it's $10, I shouldn't be greedy. Particularly, let's say you are starting with $20, and then from here to here you have gotten $10. That means you have made 50% of your money, for crying out loud. Is that not okay? Even if it is just $3 or $4 you have made, fine. Wait for another opportunity to enter. Now, mind you, I'm doing all these things on 1 hour. I'm doing all these things on 1 hour. So the market might be still showing me $2. I don't have this. I don't have a problem. Why? Look at my capital, $86. So I know that I can choose not to even put stop loss. Why? Because I know that the market is most definitely spike and hit my target. Maybe I'm not putting stop loss. Why? Because I know that I want to just achieve $5, $10, $20. Now, I am not advising you to trade without stop loss. No. The people that can afford to trade without stop loss are people that are starting with $1,000 or $500, and I enter them with this kind of lot size, this 0.1 lot size, for crying out loud. When will the market go up and eat up their $1,000? But that is not the right way to trade. That's for professional traders. But for now, learn to set up your stop loss. Why do we do that? Because we know that the market is spiking downward. And so that way, we know market will spike downward later on. I am entering late. I'm just giving us an example. Where I entered now with this example is wrong and the wrong place to enter the market because we are entering at a very wrong timing. But this is just for the purpose of education. I can choose to say, okay, I will enter from this point. I'm expecting that when the market touches this, the market will always react at a higher moving average, particularly 50 moving average. Market always react, particularly in a spiky market. So what I would just do, I will not say, okay, I'm entering again. So in case the market gets up there, I will enter again. I'm showing us another strategy. I will not say I'm not entering with 0.1 lot size. I will say I'm entering with 0.12, right? So that I will make better money. Now, before the moment the market gets to this point, and then if it spikes from here, I will make it bigger money. I don't care whether the spike reach where this 0.1. As far as I'm in profit, I'm out. This is another strategy. So please, most of the things I'm showing us here, you may have to watch the video over and over again. And if you see the relative strength index down here, you can see that it has reached the top. 90% is overbought. Any moment from now, we're expecting a spike down on the 1 minute time frame. Even on the 5 minute time frame, the 5 minute time frame is telling us, we still have a long way to go. While the relative strength index is touching the midpoint. Now, it's not saying we have a long way to go, because anything above the 50 moving average is overbought. But you don't begin to enter sales from the 50. You wait when it gets to 90. The 90 is telling us that we still have a long way to go upward. No wahala. That's why I've set this sell limit. You see, at 1 minute, in the 1 minute time frame, I set the sell limit at the 50 moving average, while on the 5 minutes, it's actually sitting at the fast moving average, which is this ones, the 13 and the 9 moving average. So market on a higher time frame react to the moving average, while on the lower time frame, it reacts when it reaches a bigger or a larger moving average. While on the higher time frame, as you progress on the time frame, the faster moving average also react price. You can see how the price reacted here. You can see how the price reacted here. Now we're explaining to us how to trade just with moving average later on, not for today. You can see that the market retraced back to the 50 moving average and bounce back. Retraced back to the faster moving average and bounce back. We're expecting it to react on this point. If it does not react at this point, we expect it to react at this point. Overall, we are not scared because the directional bias for the day is downward market. And very soon, my next limit order will trigger. So please, for now, don't add too many orders just the way I've added this sell limit, particularly if you're starting with a small account. No. This strategy is for accounts from $50 to $100 or $200. You apply this strategy. But for $50, $20, no. Our aim is to try to enter the market at the right time, where we are actually buying at a cheaper rate. If you bought here, you are buying it cheaper than you buying here. If you are buying here or you are selling here, you are actually selling at a you're actually buying at a quite expensive price. I will explain to us what it means buying or selling, because basically what we are doing, you are actually buying. You're actually buying an asset at a cheaper rate. That's what we are doing. Whether you are entering sell or entering buy, economically or in layman language, we are actually buying an asset. Our aim in this market is to buy an asset at a cheaper rate and sell it at an expensive rate. That is the traditional, simple economic way of doing business. Cryptocurrency is easily manipulated. Geopolitical news or one news, maybe a wallet was hacked or a broker was hacked, it can just crash the market at any time. And then one of the reasons that makes the markets goes down by the weekend, most times the Asians and the Americans are actually trying to liquidate their assets to enjoy the weekend. And then they come back to begin to buy. So they liquidate so that the market will fall. And then they come back to buy it cheaper by Monday or Tuesday. So that's what they do. So that's also a strategy some people do. So they pull out by big. Some people from Thursday or from Friday, they need to pull out. They are selling their assets, and then the market crash maybe by like 0.5 or 1%. And then some people hurriedly are afraid and sell, fear of missing out, or FUD, fear, uncertainty, and decline. Those are terminologies on crypto. And then when there's FUD, fear, uncertainty, and decline, everybody's scared and sell off. And the moment you sell off, they are happy because they create fear and then come back on Monday or Tuesday. They even pay influencers and bloggers to create fake news. And by Monday or Tuesday, everybody understands that it's fake news. They are happy. They come back by Monday, Tuesday. They already have a support level where they actually want to buy, and they're waiting for the market to hit there. They set their buying limit order. The market triggers it. They don't even have to watch it. It buys there and fine. They have money. So that's crypto level of manipulation in altcoins. We do that a lot of altcoins. Even Bitcoin that does that too. So for synthetic, it's not always true for all. Now, if this is for Pen X 800, let me go for another Pen X 99. Well, you see, when I go on the daily, they are all coming down. It looks daily, they're all coming down. Let me go to, I've not really studied if that is analysis works for synthetic, but you see for this one, it's a bit different. This is Gain X. This is Gain X 99. It's actually going up. It's not coming down. When you go on 1 hour, you see that it has been going up. So being weekend, you can see the directional bias is upward. It's not downward. Have I answered the question now? You can see the directional bias is upward, not downward. So these were my own analysis that I did today. I made some $1 or so. That's why I've seen a lot of chart. This was the analysis I did today. And I knew that the market was going to go up. Why? Because the support of yesterday was breached. This is what I explained to us earlier. You see, the support was breached. The candle closed up. Actually closed. This support you're seeing here was actually here below this point. So the candle body formed above, left the wick below this line. What we'll call it liquidity sweep. Sweep this liquidity and then see what happened. Boom. Today is gain. So gain, for this gain, you can now, you see, it's a spiking market upward. So if you are counting candle, you don't stay too long in the counting candle for gain 99 on this day, because the directional bias is upward. Just the way you have gain X 99. Please, any other question? I think it's gain X 800 that is spiking downward. Please, any question?
Yes, I have a question. Good evening, sir.
Good evening, please.
Can you hear me?
Yes, I can hear you.
Okay, good evening, sir. Thank you so very much. So I actually have some question. My number one question is that, therefore, I wanted to ask, what is the best time frame can one actually trade on? That is my number one question. Then my number two question has to do with the moving average. I saw you when you were explaining the moving average. I was seeing some number, those numbers that there is one that I was seeing those differences in number where we have maybe 50, 20 on the moving average. What were they actually communicating? And then at another point again, still on that moving average, when I was studying the trend on this this demo account. So I found out that at some point you see the moving average, there are some big distance apart, they have big gap apart. And sometimes you see them coming closer together, the two lines. At times you even see them cross to each other. So what means were they passing at that particular time was? So I become confused on that. So I want to get some clarification on that. Thank you.
Okay, thank you, welcome. Let me get a clean chart that doesn't have Okay, I'm actually taking this class slowly, and at the same time, it's like I'm giving so much information, and I'm careful not to confuse some people. Even though the class is recorded, it will be available for people to take their time to watch it. And
I can't hear you.
good.
This network.
Now, can you hear me now? Can you hear me now? Can you hear me? I don't know whether it is you or my network or the general house. Can you hear me?
We can hear you, sir.
Yes, we can hear you, sir.
All right.
Very well,
Okay,
sir.
I think maybe the person. Okay, I think the person that asked the question probably this is network. So, but let me answer the question. Now, you can notice that the moving averages actually crossed. Now, in trying to enter the market, you can just use the cross of the moving average. You can see this candle this bearish candle retrace back at this cross. This is a very high probable entry. The moment the fast moving average cross the slower moving average, let me start from going here to explain to you this moving average. This 9, which is red color, is more faster than this 13 moving average, and 13 is faster than 50 moving average. That's the difference between those numbers. That's all you should just store in your head concerning those numbers. I repeat myself, the 9 is faster compared to 13. 13 is slower compared to 9, and then 13 is faster compared to 50. The lower the number, the faster the moving average aligns with the price. What I am
Sorry,
saying, the red now, you
minutes.
can see that the red. Okay, can you hear me now?
Very well, sir.
Hello?
Very well, sir. I
Can
can
you
hear
hear
you
me?
now.
All right, okay. Now, what I was explaining earlier, I
Yes,
said
sir.
the
I
moving
can hear you
average,
now.
the moving average, the lower the moving average, the faster the line. The moving average is only telling you the average price over a period of days, over the period of 9 days. The average price, the exponential price over the period of 9 days, right? And then the exponential price over the period of 13 days, and then the price, the average price, exponential moving average price over the period of 50 days. So you expect, and then to understand, you are supposed to understand that the lower the days, the faster the moving average, because the moving average will actually tell you what happened over the previous 9 days. And then the cross here is actually this thing I've seen that happened there. There was a cross that happened within this number of days, where there is a cross between the 9 and the 13. And it happened, and this price honored it. So when there is this cross, when the faster moving average crosses the slower moving average, or the 9 crosses the 13 from bottom, you can see they're all pointing upward. It's a bullish market. Now, when they cross this way again, when the faster moving average cross the slower moving average, meaning the 9 crosses the 13 downward, and they are pointing downward, that tells you the market is coming down. Additional confirmation, you can see a bearish candle. This bearish candle, it's a very big bearish candle. You can see it crosses down below the 50 moving average. And then you now see both the 13 and the 9 moving average crosses what? The 50 moving average. This is a clear confirmation that you are in a bearish market. Then what were you supposed to do when this candle happened? You just now you now say, let me just enter. Then you now enter from this point. It's a sell, and then you see this candle begin to go up. You say, but this market, based on what I want to say now, this thing have crossed. This market is supposed to be coming down. So what is happening? Let me show you one secret. What you are supposed to do, whenever this moving averages crosses like this, always wait for the price to retrace back to the 50 moving average. That is what happened here. You can see the market retrace back because you are supposed to enter at this point. You cannot just put and enter. You have to wait for the moving average to tell you when to enter. They have crossed. What they're supposed to do, the moment they have crossed, the market has crossed. They have crossed, and probably market, the candle, this was a candle that formed when they both crossed. What you're supposed to do is just to set a pending sell order here at the 50 moving average, or at the midpoint of this long candle. You find the midpoint of this candle, but preferably look for close to the 50 moving average and put your sell limit. Put your stop loss right above. You can choose for, mind you, your stop loss, make sure it is not against the spike, because spike does not respect stop loss. Let me mention that. Spike does not respect stop loss. If you are trading against spike, forget about stop loss. It is where the spike stops. That's where it will show you minus. Let me repeat myself. Spike does not respect stop loss. Take note. Stop loss is only respected when you are counting candles. Don't worry, we are in this class, you will understand what I'm saying with time. You understand what I'm saying? But just not to confuse you. You can see I am setting my take profit and whatever, and then my take profit will be where this candle, this long bearish candle, where it stopped. Now you can see my stop loss is $4. My take profit is 13. You can see it's over almost 3 times the profit. This is what you should have done. Now you are still not late in the market. This market, I can say enter, sell. But how do I know that whether it is spiking down or up? To make it easier for yourself, in case you are confused about this pain and gain, just go to 1 minute. You see the spike is actually downward. You see this large, the spike is actually a bearish spike, and that is the redirection. It doesn't mean that every spike that is the direction of the trend. No, the direction of the trend can also be counting candles upward. That means that the direction of the trend based on analysis is counting candles. That means that you have very long counting candles. You need to be very long before you see a spike, which is preferable, because this one, the moment you just enter, you start making your profits instantly. But for when you are trying to hunt the spike, the moment you enter, you'll be seeing minus, just the way we entered earlier. You see the minus is still counting. I don't care, because I know that it's going to spike downward. It's not the best way of entry because we entered late. That's why you're seeing that long minus. But now, if you are trading, if the directional bias is in the line of these candles, you see that the counting can go up to 20 before it spikes. And when it spikes, it will not even come back to where you started. No, it will just stop halfway, continue counting again. Oh, so you start the analysis by starting from daily and taking the previous day high and low. It helps you understand the directional bias. This is elementary directional bias. There are other 3 to 4 ways of getting the directional bias, and we cannot talk about that one now. It is when we started proper, we begin to show other way of knowing the directional bias. Directional bias is knowing which direction the market is going for the day, right? So I try to explain the moving averages. When they cross from top, when the fast moving averages crosses from top to bottom, crosses the slower one, and they're all pointing downward, my brother, just go down. Just know it's a sell market. Now you can do the analysis on this 1 hour time frame. Preferably, I can tell you concentrate on 15 minutes. You ask the question on which time frame is the best. We start our analysis from daily, right? You can also even start from 4 hours. Now, I am avoiding 4 hours for now because there is another analysis that we're using 4 hours for. For now, let's concentrate on day, right? 1 hour, and then you can come to 5 minutes or 15 minutes. Best, I will tell you, from day 1 hour, come to 15 minutes. And then on 15 minutes, it will be more faster for you to see what is happening. You don't have to wait for the 1 hour. The 1 hour will take you a longer time. You can see the moment the 9 crosses the 13, well, it's telling you the market is going down. And then see the candle that broke it. Boom. What do? You wait for it to retrace, the candle to retrace back to the 50 moving average. That's where you're supposed to enter from this point. Look at what happened. Come down again. Look at what is happening. Why? Because we understand that the directional bias, the moving average 50 always confirms to us that the market is down. Each time the market comes to the 50 moving average, look at what happened. It reacts, it comes down, it hits it at the 50 moving average. You're thinking of entering and place your stop loss above it. Do you see when it gets? Do you see the way it's reacting? And then it will come down when it gets to then also wait when it gets also wait for it to cross the fast moving averages. If you want to be conservative, when it reaches here, you wait for the candle to also cross the fast moving average and wait for it to retrace a little to the fast moving average to enter. Boom, you come down. You can just be milking the market like that. 50 cents, $1, $2, $3. You can spend 1 hour, 3 hours, 10 minutes, 15 minutes. It's all up to you, the amount of time you want to spend. So based on your question, I will tell you come on daily, then 1 hour, then 15 minutes. I don't really support the 1 minute. You can only do the 1 minute when the directional bias is counting candles. You'll be counting candles 1, 2, 3, 4, 5, 6, 7, 8, and most of my trading, I don't come to 1 minute to do that. I get the holistic view from my daily 1 hour and then 15 minutes I execute. I don't know if I've answered your question. Hello? Hello? Well, maybe the network has taken him out. And the one thing I must also add is that the moment the crossing happens, always confirm this crossing with your relative strength index. Check out what happened here when price reached the 50 moving average. The RSI was also overbought at 90. So you see you have double confirmation. Confirmation number 1, which is the moving average, price toward the 50 moving average. Confirmation number 2, you can also wait for this fast moving average to also cross themselves, pointing downward. Confirmation number 3. So if you are waiting for all this, you see you would have missed the trade. So the moment it touches the 50 moving average, which confirms the directional bias, and my RSI is already showing overbought here at the top, what am I waiting for? I enter my market, boom. The moment it crosses this, I jump out or touches the next moving average, I jump out, or the RSI touches below, I jump out, or I just relax. Since the moving average is up there, I wait, I only come out when the moving average gets to oversold. So the moment it crosses the midpoint, I jump out. That's at this point. That's at this point, you can see this cross here I just picked. So at this point, I jump out. The market, that's at this point, I jump out. The market is below the midpoint. And now I wait again, I enter again, I wait for the market to retrace back to the 50 moving average. It got to this point. When it gets to this point, I enter again. I enter again. When it gets to the over, so I jump out. I wait for it again. It might not get to the 50 moving average. At this point, since the market has closed below this point, I'll be looking at the fast when they crosses. I enter from this point and then it's going up. I wait for it when it reaches the dust. I jump out. So, but let me tell you how far this market is going to come. It's going to come down to this point. So you can also set your support and resistance here also. I can also pick my support and resistance, not just the daily. You don't just use the daily for support and resistance. You can also put your support and resistance on a lower time frame, just like this, and set it here. So what am I saying? I'm expecting that this market will come down to this point, but I'm not entering yet until the RSI gets to overbought. So I enter. My aim is to come down to this point. Some people could enter from this point and wait. They enter just from this point and they're not coming out until the market gets to this point, to this support level. So I think I should be stopping here, except for any other questions that I can answer. But because we have spent over 1 hour, 30 minutes on these tutorials, and we cannot finish everything in one day. Any question, please, on what I've shared so far?
Yes, sir. Good evening, everyone. Good evening, sir.
Good evening.
Good evening.
Okay.
How do
Okay.
you draw this this green line that is 4 corners showing on your phone? How did you draw it? How did this color come about?
Okay, this color at the end of my phone round like this.
Yes.
No, that one has nothing to do with the trading. It's Zoom that did that one because I'm sharing my
Okay, sir.
screen.
Okay, sir. Okay, sir.
That
Then
one,
when
that
I'm
one is not part of anything trading. It's
it's
just
not
Zoom
part
that
of it. Okay,
draw
sir.
that line. I don't know why they
Okay.
did. Yeah, it
But
has
when
nothing to
I'm
do with
putting my stop loss and my take profit, it doesn't stand for me. I will be strongly to make it stand. It will not stand for me to go and put in take profit. At a time, I will just leave it and take the little trade I want to take like that. Sometimes when strike come in, it will just take all my money. So how do I make it
Okay.
stand the way you are doing your own?
You press and hold it. Isn't it the take
Okay.
profit and stop loss you're talking about? Okay.
Yes, sir.
Let me do example now with this market that I'm expecting it to, like this 1 hour trade. It has touched my support and it's below my 50 moving average, and I don't know the directional bias. It looks like it has touched the support and I'm expecting it to go upward. So, but why I might not enter this trade now? Why? Because everything is below the 50 moving average. So it's not the best place to enter. You know the 50 moving average, this white line is the 50 moving
Yeah,
average.
the white line.
So,
Yes.
but just for so just to answer your question, let me say I am placing a trade, right? This is
Okay.
just
Yes,
for
sir.
purpose of example. So let me say I click buy. I just click buy, right? Now you
Yes, sir.
know the I didn't go to pull stop loss, this. No, I just click buy. What you should do, just click where that line, you see a line. Where you enter,
Yeah.
where you entered your buy, just click on it, just
Yes.
single click. You see it as
Okay.
highlighted. Do you
Yes,
see
sir.
below here?
Yeah.
Do you see
Close
below
on
here
stop.
showing close, stop loss, and take profit? Do you see it?
Yes, sir. Yes, sir.
So you click on the stop loss,
Okay, sir.
right? You know, I
Yes,
entered
sir.
buy, I put the stop loss. The stop loss should normally the stop loss is supposed to be below the support. You know, this my blue line, I told you is the support. It's supposed to be
Yes.
below the support or the
That's
lowest candle. Then, then I now click on the take profit. I put the profit to be the high, the candle that is the highest there. I just put it. Now, how do I make everything to stand on the screen? If I
yeah.
click on this screen, everything will disappear. So this is what you really experience. Everything has disappeared,
Yes.
right? I understand.
Yes, sir.
So when you click on it, just put the stop loss here, put the take profit, just what I explained. Now you see this arrow. Do you see one blue arrow pointing to my right here? This place you saw stop loss, and where we click stop loss, take profit. Do you see one arrow pointing to my right? There's one arrow here. Look at it.
Okay. This white arrow.
Let me do it again.
Yeah.
Let me put let me click stop loss here. Let me click take profit here, like this. After where I click this take profit, do you see one arrow? There's an arrow there.
Take profit. The one that look like zero.
This is where see, this is where I click here. This is where I'm clicking. I click stop loss here. Then the next I click take profit. This is where I click it. After where I click, do you see one arrow?
Yes, I saw the arrow.
So when I touch the arrow, the next thing I need to do, then I click modify.
Okay.
That's all. Done.
That's
Do you see everything has stayed? Do you see
Yeah.
the chart now showing my take profit and my stop loss?
Okay, sir. Thank you very much, sir. When
You're welcome.
buying,
So you can
when buying, take profit will always be at the
yes.
down. When selling, stop loss will be at the top, right?
Yes. When selling, stop loss should be at the top,
Okay, sir.
right? When
Yes,
selling,
sir.
stop loss should be at the top, while
The
take
top,
profit should be
at the
bottom.
down.
If you are
Okay,
buying,
sir. Yes, sir.
okay. Let me do it now. This one now I have what we do here. You buy
Okay.
what we buy just so that's why we put the stop loss.
Okay,
So
sir.
you should do the opposite when you are selling. Any other question? So do you see, because my directional bias seems to be counting, you see it's counting. So automatically I started. Do you see that spike? And I told you that it's going to spike downward. Do you remember that
Okay.
chart? So if you
Yes,
have to go to
yes.
the charts from the trade, just click here, click and hold. I'll just click my chart. I'll just go to the chart. Do you all remember that spike I told us that it's going to happen?
Yes,
Do you
it
all
has
see it?
happened. I'll give you
So
profits. Yes.
it has happened. This is the live trade. We have placed a live trade and practice. This is practice. This is not theory. And you can see it happening the way I told you. So why should I wait? You see at the top here, I've made $2 something. Even though I still have a losing trade, what should I wait? I didn't kill anybody. All I need to do is just click and hold, click bulk operation, and then close off.
Okay.
I can click, see, it has closed everything. I've made $2. I come to
Yeah.
history here. There are many losses I've made. I reduce this account so that it can be low. So here I was doing research and development. So you see all the losses, to show you all the losses you have made and the profits you have made. So the trade for today will show you everything that has happened. This trade that will close, you show all the profit and the loss. It is here you see it. So normally at times when you are doing research, you do demo, you place. This is how you learn. You open another demo, go blow it, start all over again, blow it, start it all over again, blow it, start all over again until you master it. So all these ones were practice I was doing that is showing all this. So I have closed with $2. Now we still have a pending market. I can always close here, I press here and close and go to chart. If I'm no longer interested in that particular trade, I go to here, I just click hold and just delete. All right.